recent piece. It's the smart move, flags, tricolor, and first brands and canaries into 2007 early cracks. I'm going to leave it there and turn it back to you to tell us what you're seeing today.
Sure. So February of 2020, we're seeing from a narrative point of view, a storytelling point of view, is the dominant narrative in the United States around COVID was it's just the flu. And what we're able to pick up from China, to your point, was the numbers being constructed. I mean, we reverse engineered how they were generating the fake numbers that they were coming out of Wuhan. So, that was the source there, and the source of my nervousness, which was, that there was a tsunami coming. The tsunami, the economic tsunami, like say in 2008, we had an amazing year. And it was because we were able to identify the canaries in the coal mine in 2007 for real systemic stress and a banking system, not collapse, but seizing up of the banking system. So there were these two funds that went out in the summer of 2007 from Bear Stearns. And that was the first time that these funds that had highly rated tranches of mortgage-backed securities, they failed because of the default pattern that was happening already in 2007 in the United States. So I'm sure as a lot of your readers, recall this time where Bernanke was saying, oh, subprime is contained. You'd go to the countrywide conference call and they'd be showing the evidence. Well, maybe it's a little bit on Alt-A's, but it's going to be fine. These stories and the real life of them, they spread like a virus. It's the same, again, it's the same math. So the stories today and about it's being contained, but
what is being contained?
Defaults, right? So in the same way that the root problem in 2007 going into 2008 was a nationwide decline in home prices leading to widespread mortgage defaults. That's what blew up the world in 2008.
Yep.
Today, my strong sense is that we are seeing widespread stress in credit, not in residential mortgages, but in commercial mortgages and in private loans to enterprises, what's called private credit. So the big shift in the banking system over the last 10 years has been so much of the lending into the corporate sector has moved from commercial banks to, we used to call them shadow banks, but we call them alternative asset managers. So alternative asset managers, private credit issuers, they're the ones who are making the loans to private companies. Private companies like Tricolor, private companies like First Brands that went belly up a month ago. My strong view is that there is a very similar pattern to 2007. That essentially those were the Bear Stearns funds of 2007. So we're not in 2008. Today we are
The Tricolor and First Brands.
That's right. It feels so much to me like the summer of 2007. So you are here. I feel like we're in the equivalent of the summer of 2007, when central bankers, heads of banks are saying, no, it's fine. There's no problem. It's all contained to these rogue companies. My view is that it's not rogue companies. It's far more widespread.